February 24th, 2026. What happened today in the silver market is something I have never seen in over a decade of covering commodities. And I do not say that for clicks. I say it because the data supports it. We now have two completely different silver prices operating simultaneously on this planet. One price in Shanghai, one price in New York. And the gap between them is so large, so structurally significant, that it is telling you something about the future of this market that the mainstream financial press either cannot understand or will not explain. Let me walk you through exactly what happened. Silver spot in Western markets opened today around $88 per troy ounce. It traded in a range between roughly $84.65 and $88 throughout the session. A relatively calm day by recent standards, down about 1% from Monday's close of $88.91. Nothing dramatic on the surface, nothing that would make CNBC cut to a breaking news banner. But while Western traders were watching that $88 number, something entirely different was happening 9,000 kilometers away in Shanghai. The Shanghai Futures Exchange reopened today after a 9-day closure for the Lunar New Year holiday. 9 days. The longest stretch of the year where the world's largest physical commodity exchange goes dark. And when it came back online this morning, silver did not open at $88. It opened and surged to 22,634 yuan per kilogram. When you convert that to troy ounces using today's exchange rate, you get approximately $102 per ounce. $102 in Shanghai, $88 in New York. That is a 16% premium on the same metal, on the same day, on the same planet. Let me make sure you understand what that means. If you are holding physical silver in Shanghai right now, the market is telling you your metal is worth $102. If you are holding a COMEX futures contract in New York, the market is telling you your paper claim on silver is worth $88. Same commodity, $14 gap. That is not a rounding error. That is not a liquidity blip. That is a structural dislocation that is screaming at you about the real state of physical silver supply. And Shanghai's premium is not new. Before the holiday, it was already running at 11%. Physical buyback prices in Shenzhen on February 23rd, the day before reopening, were already near $95 per ounce. What the reopening did was confirm and accelerate a trend that has been building for months. Over the past 6 months, the average Shanghai premium has been 6.59%. It peaked at 34% during the January crash. And here is the detail that puts the silver premium into perspective. The Shanghai gold premium right now is 0.29%. Silver's premium is roughly 38 times larger than gold's. That tells you something very specific. This is not a broad precious metals dislocation. This is a silver-specific physical supply crisis. Now, why does Shanghai price silver so much higher than New York? 3 structural forces. First, China reclassified silver as a strategic material on January 1st, 2026, and imposed strict export licensing. Only 44 companies received approval for the 2026-2027 export cycle, and each one must demonstrate minimum annual capacity of 80 tons. China controls approximately 65% of the world's silver refining capacity. When you restrict exports from the entity that refines 2/3 of global supply, you create a structural bottleneck that no amount of paper trading can arbitrage away. Second, China's domestic demand for silver is enormous and growing. Solar panels, electronics, electric vehicles. China is simultaneously the world's largest producer of solar panels and the largest consumer of the silver that those panels require. By restricting exports, China is telling the rest of the world that its domestic industrial needs come first. Third, capital controls, import quotas from the PEOC, and a 13% VAT on silver all create friction that prevents efficient price equalization between Shanghai and Western markets. After you account for the VAT, the effective premium during the January crash hit 45.8%. That was a $34 per ounce arbitrage opportunity that logistical and regulatory barriers prevented anyone from closing. And that brings me to the story that broke this morning that the financial media is not covering. The Shanghai Futures Exchange issued notice number 46, dated today, February 24th, 2026. In that notice, the SHFE announced that it has suspended another group of accounts for breaching Article 16 of the exchange's abnormal trading behavior management rules. These accounts exceeded intraday position opening limits on silver contracts. The exchange has imposed restricted position opening measures as a regulatory response. This is not an isolated incident. This is the latest in an escalating series of enforcement actions that have been building all month. On February 5th, notice number 37 suspended 6 groups of linked accounts for the same violation. On January 26th and 27th, additional groups totaling 34 clients were restricted. In January alone, the SHFE processed 125 abnormal trading behaviors, including 38 intraday opening volume exceedances, with restrictions imposed on 1 client and 39 actual control relationship account groups. The total number of accounts suspended or restricted in February alone has now risen to approximately 23. And here is the detail that makes this more than a regulatory footnote. Reports circulating in precious metals communities and alternative financial media claim that these accounts are linked to Western banks. Specifically, JP Morgan has been named in multiple reports. Let me be precise about what is verified and what is not. The SHFE does not disclose account identities in its public notices. The connection to Western banks is alleged, not confirmed by the exchange. However, Disruption Banking reported on February 4th that JP Morgan allegedly closed a massive short position at the exact intraday bottom of the biggest silver crash in 44 years. COMEX delivery data shows JP Morgan involved in February silver deliveries of 633 contracts at an average price of $78.29. The pattern is suggestive. Whether it is conclusive is for you to determine by checking primary sources yourself. What is not in dispute is the pattern of enforcement. The SHFE has been aggressively clamping down on accounts that attempt to build outsized short positions in silver. The exchange tightened the intraday opening limit to 800 lots per day effective January 27th. That lower threshold makes it easier for large traders to trigger violations, which is exactly the point. The exchange is sending a message. Manipulative selling activity in Chinese silver markets will be identified and terminated. Whether that message is directed at domestic speculators or foreign participants operating through intermediaries is a question the data does not definitively answer. But the timing, coming on the same day that Shanghai silver prices above $100, is not coincidental. Now, let me connect this to what is happening on the COMEX, because the American exchange has its own crisis developing in parallel. COMEX registered silver, the metal that is specifically earmarked and available for futures delivery, has collapsed to approximately 88.2 million ounces as of February 22nd. That is a 47% decline from the 167.7 million ounces held in October 2025. In 4 months, nearly half of the deliverable silver inventory has been physically removed from COMEX vaults. The rate of drainage is accelerating. In the week of February 12th through 18th, 14.07 million ounces left registered vaults. That is a 13.8% decline in a single week. Net physical outflows over the trailing 30 days total negative 54.89 million ounces, which is 3.66 million coming in against 58.54 million going out. On a single day, February 18th, HSBC lost 641,000 ounces, and Brinks lost 596,000 ounces. JP Morgan's vaults hold 12 million ounces registered, but 143.85 million ounces eligible. That is the largest eligible holding by far. But eligible metal belongs to specific owners and cannot be forced into the delivery process. March is the most active silver delivery month of the year. Open interest on the March 2026 contract stands at approximately 43,971 contracts, representing 219.9 million ounces. That is roughly 2.5 times the entire registered inventory. Heavy Metal Stats classifies the current coverage ratio at 3.8 times with a status of stress. The effective musical chairs ratio stands at 8 claimants per registered ounce. First notice day for March delivery is February 27th. That is 3 days from now. On that date, any long contract holder who has not rolled or closed their position can demand a physical delivery. If even a fraction of the outstanding contracts stand for delivery, the math does not work. 88 million ounces of deliverable metal against 220 million ounces of contractual demand. This is the same dynamic we have been tracking for weeks, but the numbers have only gotten more extreme as inventory continues to drain. February deliveries, a minor delivery month, have already been historically unprecedented. 4,695 contracts totaling 23.475 million ounces delivered month to date through February 20th, with 2,955 contracts delivered in just the first 2 trading days. January saw 49.4 million ounces delivered, more than 7 times the January 2024 level. Total 2025. COMEX silver deliveries reached 474.4 million ounces, more than double 2024's 202.7 million. And an unusual pattern of backward rolling has emerged, where traders roll from March into January and February contracts for immediate delivery rather than waiting. That signals urgency. That signals participants who want metal now, not later. I want to add an important caveat here because intellectual honesty matters. Eligible to registered conversion takes only 24 to 48 hours, meaning effective delivery capacity exceeds the registered headline number. COMEX can modify contract terms, extend delivery periods, and force cash settlement. One analyst at Seeking Alpha assessed the probability of a COMEX default at 0%. The system has shock absorbers. The bullion banks have managed similar stresses before. But the directional trend in inventories is unambiguous and accelerating. And every time the system absorbs stress by forcing cash settlements or emergency metal sourcing, it erodes confidence in the paper market's ability to deliver physical metal on demand. Now let me talk about the options market, because this is where the tension between what the market fears and what the market shows becomes impossible to ignore. SLV implied volatility as of February 19th stands between 99 and 103% annualized. The 12-month historical realized volatility is just 37%. That is a 2.7 times ratio. Options are pricing moves roughly 3 times larger than what the spot market has actually been delivering. At 103% annualized implied volatility, the implied daily standard deviation is approximately 7.3%. A 3 standard deviation daily move would imply a 22% single-day swing, roughly $19 from current levels. Yet silver has traded in a relatively narrow $80 to $88 band for over a week. The options market is telling you it expects this calm to break violently. The spot market is telling you it has not broken yet. One of them is wrong, and historically, when options markets price this much fear relative to realized moves, the resolution tends to come suddenly and decisively. The exchange for physical spread, which measures the gap between COMEX futures and London spot, widened to $1.10 per ounce versus a historical average of 25 cents. Silver lease rates spiked to 35% per annum at their peak. COMEX margin requirements were raised to 60% of notional value, a level seen only during the 1980 Hunt Brothers crisis and the 2011 top. The paper-to-physical ratio on COMEX peaked at 356 to 1. Every single stress indicator in the plumbing of the silver market is flashing red. Let me give you the gold context because it matters for the broader thesis. Gold traded today around $51.68 to $51.82 per ounce, down about 1 to 1.5% from Monday's close of approximately $52.06. On Monday, gold touched a 3-week high of $52.50, the highest since its all-time high of $55.94.82 set on January 29th. The gold-silver ratio stands at 58.74 to 1, dramatically compressed from the 100 to 1 extreme seen in April 2025. That compression signals that silver is outperforming gold, which typically happens during the acceleration phase of a precious metals bull market. The macro backdrop continues to align for metal strength. The Supreme Court struck down Trump's reciprocal IEEPA tariffs on February 20th in a 6-3 ruling. The administration retaliated by signing an executive order on February 21st, raising the flat global tariff from 10 to 15% under Section 122 of the Trade Act, effective today. Legal experts expect months of further litigation. The constitutional crisis over tariff authority creates dollar uncertainty, which is exactly the environment where capital flows into hard assets. U.S.-Iran tensions are escalating with Trump's 10-day deadline for a nuclear deal approaching and significant military assets positioned in the Middle East. The Fed held rates at 3.5 to 3.75% at its January meeting. February FOMC minutes revealed deep divisions among officials. Core PCE inflation remains stuck around 3%, while Q4 GDP printed just 1.4%. That is a stagflationary combination that is historically bullish for precious metals. CME FedWatch shows a 92% probability rates hold steady in March. The dollar index has fallen below 97.5, down roughly 8.5% over 12 months. UBS raised its gold target to $6,200 per ounce by mid-2026. Wells Fargo targets $6,300. Bank of America's silver target stands at $309. Citi targets $150 near term. These are not fringe voices. These are the largest banks on the planet publishing price targets that imply silver has significant upside from current levels. Now the mining stocks, because this is where the disconnect between reality and analyst models is most extreme. First Majestic Silver, ticker AG, closed at $28.60 on Monday, near its all-time high. The stock is up 413% over 12 months. Q4 revenue came in at $463.9 million, up 169% year over year, with net income of $105.2 million versus a loss of $13.5 million in the year-ago quarter. H.C. Wainwright raised its price target to $30. Pan American Silver at $65.18 delivered record cash flow of $554 million in Q4 and completed its acquisition of Mag Silver. Hecla Mining at $23.99 posted record 2025 revenue exceeding $1.4 billion. These companies are producing silver at all-in sustaining costs of roughly $11 to $14 per ounce. Silver is trading at $88. The margins are extraordinary, and yet analyst models for these companies still assume silver prices of $25 to $50. The Street has not updated its models. When it does, the repricing of mining equities could be violent. SLV closed at $80.57 on Monday, up 5.16% on volume of 109.9 million shares. But here is an interesting divergence. SLV saw $1.28 billion in 5-day net outflows despite the price gain. Institutional players are taking profits even as the price rises. SLV's premium to net asset value widened to approximately 5%, indicating retail buying pressure exceeding underlying silver value. Meanwhile, Sprott expanded PSLV's at-the-market equity program to $2 billion, signaling confidence in sustained demand for physically backed silver exposure. Let me give you the honest bear case now because this channel does not do hype, and I will not start today. First, Shanghai's reopening created a catch-up move after 9 days offline. Some of that premium may compress as Chinese and Western markets resynchronize over the coming sessions. Price dislocations during exchange reopenings are common and do not always persist. Second, the COMEX delivery stress, while unprecedented, has produced managed resolutions in every prior episode. Cash settlements, emergency metal sourcing, position rollovers. These tools exist and have been deployed. The system has not broken yet. Third, silver's 103% implied volatility works in both directions. If the resolution of the current setup comes as a sell-off rather than a rally, the move could be equally extreme. The January crash from 121 to 64 proved that silver can lose 40% in 30 hours. Being positioned for the long side without risk management is how people with a correct thesis lose money. Fourth, industrial demand, which accounts for over 50% of silver consumption, is not immune to economic cycles. A genuine global recession would reduce solar installations, electronics manufacturing, and EV production. That would temporarily overwhelm the supply deficit narrative. Q4 GDP at 1.4% is not inspiring confidence. Fifth, the analyst targets circulating right now, $309 from Bank of America, $150 from Citi, are based on balance sheet math and historical precedent. That is genuinely valid, but valid on timeframes that may extend well beyond most people's patience or planning horizon. Howard Marks wrote something that should be tattooed on every precious metals trader's screen. Being right about the direction and being right about the timing are two entirely different skills. These are real risks. They deserve to be weighed alongside the bullish case. Anyone who tells you silver can only go up from here is selling you something this channel does not sell. Here is what all of this means taken together. We are watching the silver market operate as two separate markets for the first time in modern history. Shanghai is pricing physical silver above $100. New York is pricing paper silver at $88. The Shanghai Futures Exchange is actively suspending accounts that attempt to build manipulative positions, with 23 accounts restricted in February alone. COMEX registered inventories have collapsed 47% in 4 months to 88 million ounces, with March 1st notice day 3 days away and open interest representing 2.5 times the available supply. Options markets are pricing 3 sigma tail risk while spot consolidates in a narrow range. Mining companies are reporting record revenues and extraordinary margins, while analyst models assume silver prices less than half the current level. The monetary regime shift is not a future event. Central bank gold holdings exceeding treasuries for the first time since the 90s. The dollar's share of global reserves at a 32-year low. BRICS nations piloting a gold-backed digital settlement currency. U.S. national debt at $38 trillion. These are current conditions, not projections. The COMEX delivery data is public. The Shanghai Premium is public. The SHFV enforcement notices are public. The COT positioning is public. The options implied volatility is public. The ones who verify primary sources understand why what is happening right now is not noise. This is financial warfare education, not advice, not a signal, not a call. Verify everything I have shown you tonight. Check the data yourself. Do the math. And understand that the next 72 hours, heading into February 27th, March 1st notice day, may determine whether the paper silver market can continue to function with an 88 million ounce inventory against 220 million ounces of contractual demand. The answer to that question will not come from me. It will come from the market. Invest with logic, not hype. I will see you on the next one.